Hey, my name's Rajesh. I'm a direct lender based in Los Angeles, and today I'm going to discuss 5 ways to buy a rental property with 0% down. But before I get into that, I want to define what I mean by 0% down. I mean that you're going to use 0% of money that you currently have in your bank account. So if you've only got 10 grand in savings, $1 in savings, even if you've got $1 million in savings, you're going to use 0% of that to get the property. And here is how we do it. So the first way is to get an equity partner. What that means is that you're going to partner up with somebody who has the money, and then you're going to manage the build. You're going to identify the deal. You're going to manage the building, and all they're going to do is put in the money and sit back and collect their return, the returns on their investment. Normally, what that means is they get 50 to plus % of the cash flow, and when you guys refinance and sell it, they get their original investment out and then some. And you walk away with enough money to do the next deal or the third deal on your own. So that is what I mean by equity partner. So here it is in simple diagram. Here's you, bright-eyed and hopeful and optimistic, and here is your equity partner who is rich. And he's got his shorty with him. There we go. So that's your equity partner, and you guys are buying the building. You are the searcher and the manager. Manager. Let's see. What's a good icon for manager? Let's see. Maybe some sort. Nah, that's not really a manager icon, but this is the money icon. Your equity partner brings in the money, and you find the property. And that's how you guys get in. In order to make money from this, you are going to generally manage the property. You manage them, collect percentage of cash flow, and then in, let's say, 2 to 5 years, do a cash out refi or sell. Well, let's put that 1 to 5 years, or sell and split proceeds. Normally this is 50%, but that really depends on your experience. So if you're a professional property manager, 50% is reasonable. If you have a good relationship with them, 50% is reasonable. But they might be in a place where they're like, I get 90%, and you just care about the exit because, hey, now this is your side hustle, and you might even say, let's say you get to keep 100% of the cash flow, and you'll just take a salary. Maybe you'll take 8% of rents. Right? And they get 100% of the cash flow. And then in 1 to 5 years, when you do a cash out refinance or sell, then you're going to split the proceeds 50-50. So that's one way to structure it. There are other ways to structure it. The point is to make an offer attractive to them so that they believe and that you have enough credibility behind you so that they believe that they are getting a good deal for their 25 or 20% down payment. And sometimes that might even require a 35% down. The point is that they are putting in a percentage of the purchase price. So here is the building, and they're maybe putting in some fraction of it, and they are getting a loan for the rest. And the ownership, the title, is in yours plus their name. And so that might be an LLC. That might just be your personal name and their personal name. I would recommend an LLC. So that's way number one. Way number two is seller financing. So the way to do this is to say, is to look specifically for properties that sellers are open to financing the property. So here is the house. Maybe it's a duplex. Well, no, let's say it's the same exact building and this seller is open to seller financing. So instead of going to a bank and getting a loan, and here is the seller. He's old and he's looking to get out. And here's you, bright and optimistic. So here is the bank. Instead of going to a bank to get the money, you go directly to the seller and say, hey, I'll put 0 down, but in 1 year, I will do a cash out refi. Or sell, and then pay you the rest of the money. So here it is in numbers. So let's say you have $1 million building, and here's you. You have $0. What you're going to do again is go to the seller and say, hey, I will give you 0 down in 1 year now, but in 1 year, 1 to 5 years, some may even go 1 to 10 years, I will give you 100%. I'll give you $1 million on top of whatever monthly payments I've been making. So there are different ways to structure this deal. Some sellers will say, well, I want 10% interest only for until the $1 million is due. Some will say, okay, I want 0% interest. You just pay me, I don't know, a percentage of the cash flow. Pay me $5,000 every month, $10,000 every month. And then after 1 year, you will have paid $120,000, and that is roughly 12% of that $1 million. So now you can go and get outside financing. In reality, on a $10,000 a month plan, you're more likely going to have to wait until you have 24% interest to get financing. So you may this would likely be a 2-year deal. So let me put that more clearly. So $1 million, 0 down, 0 interest, $10,000 a month, for 2 years, 24 months. Now you have $240,000 in equity. And then you refi. And that's it. Yeah, that's pretty much it. That's the way seller financing works. I did just think of something for the equity partner. So let me show you another way to do this. So this way is going to actually combine seller financing with equity partner. So there's a bonus. This is let's call this 2.5. Okay. So what we're going to do is we're going to go buy a building, and this is helpful for agency loans. Okay. So by agency loans, I usually mean a bank loan or a small balance Freddie Mae, Fannie Mac loan, more specifically. But the way to structure this is you would go to the seller and say, I will, and here's the seller, and he's selling it for $1 million, and you have $0. So you're going to go to the seller and say, I have $0, but I will give you 80%, well, more like 75% of the purchase price, or in this case, $750,000 at close of escrow. Okay? And they're like, what about the other 25%? Or $250,000. And you're going to say to them, well, you're going to get you're going to keep 25% equity in this building. And then in 1 year, I'm going to refi you out. So you get $750,000 now. And then in 1 year from now, you get $250,000. So that way, you do not have to wait too long to get your money, one, and two, you don't have to give a discount on your sales price, because normally when people buy a building, they might say, well, we only want to pay $990,000 or $950,000 or $900,000. Either way, these are pretty big numbers. This is $10,000 less. This is $50,000 less, and this is $100,000 less. Now, each of these numbers sound like, well, that's not much difference from $1 million, and that's because you're comparing 10 million or 10,000 to 990,000 and 1 million. But I bet you if I were to put $10,000 in your hand right now, that would still be life-changing money for you. So every little bit counts, especially for the seller. So if you can give them the full million, or even let's say $1,010,000 or $1,100,000, right? So you say, hey, in 1 year you will get 1.1 million total, but right now you are going to get 750,000, and then you're going to pay the 350,000 1 year from now. Full price and then some. a lot now, which is, if you imagine with seller financing, remember you could put as little as 0 down, assuming the seller was open to it. But they might say, no, we only want you to put $100,000 down, or 10% down, or 25% down, or 50% down. Well, with by structuring it as an equity deal with the original seller rather than an outside third party, this is like putting 75% down, because this comes from the bank. Okay, and they hold on to the 25%, not as seller carry, not as a note or seller note. That's not what this is. This is 25% equity in the new building. So essentially what they're doing is they are adding you to the LLC, them plus you, and then doing a refi at 75%, and then in 1 year they will refi themselves out. So that's how that works. That's number 2.5. So just to cover what we've done so far, we've done equity partner, we've done seller financing, and we've done a combination of equity partner and seller financing. And now we're going to do an unsecured line of credit. So with the previous types of loans, we have done secured lines of credit. Okay, so an unsecured line of, with a secured line of credit, that means if you no pay, if you don't pay, they take collateral or whatever was used to guarantee payback. Okay, so that's a secured line. That's secured lines of credit. That's where there is collateral. So think of it like a pawn shop. You need money, so you give up something of equal value, of equal or greater value. You get that. You get money, and if you don't repay them back, they sell that thing in order to collect on the money that they gave you, and you lose ownership of that thing. So in houses, if you don't pay your mortgage, the bank or the lender will take control of that house. You will lose ownership of it. The bank or institution is now the owner, the lender is now the owner of that house, and they will sell the house to recover the money that they lent to you. That's with a secured line of credit. With an unsecured line of credit, you are getting money like a credit card. So what happens with a credit card? Credit card. With a credit card, let's say you swipe your card. The card pays for that thing that you're buying, that purchase, and then you have to repay that purchase over time. But what happens if you don't pay? If you no pay, then you do not lose ownership of that thing that you bought. You just get a mark on your credit card. you get bad credit. So you still keep your money that you saved by not using your own money to buy the thing. So you get to keep the money and you get to keep the thing. So let's say it's some sort of video game console. You get to keep both of those things, but you get bad credit, so the chances of anyone giving you unsecured or even secured lines of credit in the future go down. So you get to keep the money, your money, you get to keep the thing, but you lose your future. You lose your future ability to borrow, but lose future ability to borrow. And you're like, well, how do I get an unsecured line of credit for $1 million? That is easy. Have $1 million in the bank. Seriously. There are banks that will match whatever cash or stocks that you have liquid with a matching unsecured line of credit. This is a personal line of credit. So if I had $1 million sitting in the bank and I didn't want to go out and use $250,000 of that money to buy an apartment building, what I would do is I would go to a bank and say, hey, I'm going to deposit $1 million in your bank account, and in a savings account in your bank, and I want you to give me an unsecured line of credit for $1 million. And if it's cash, they will match it 1-to-1. If it's stocks, they will usually match it somewhere between 90 to 97%. What that means is that they will say, we won't give you $1 million just because you're housing $1 million of stocks in our bank, but we will give you $900,000 as a line of credit, or $970,000 as a line of credit. And now you're getting it for close to zero down. So you might get it for $30,000 to $100,000 down, or 3% to 10% down instead of 25% down, which on a 5 plus unit building is the minimum. So, and that's one way to use an unsecured line of credit. Another way to use an unsecured line of credit is a business line of credit. And this is for business owners. If you have a business that is doing $1 million a month in revenue, not net profit, but gross revenue, we can get you a business line of credit for up to $1 million. If you have balances on your account of, let's say, on your business credit cards and business credits of, let's say, 250K to 300K, and your personal and business credit scores are top tier, so let's say 750 plus, or greater than, greater than or equal to 750, then we can usually do anywhere from 3 to 5x of the existing balance. So this is existing balance. So if you have a line of credit at one of your suppliers for, let's say, $250,000, $300,000, one of your vendors, and you need $1 million line of credit, you would go to a specialty lender or broker, and they would sign you up at various banks. where you would deposit a little bit of money and then you would open up multiple accounts, getting anywhere from 3 to 5 times, even 1x, your existing lines of credit. So let's say if you can go to one bank and get 4 times 300,000, that's $1.2 million. Now, if you have to go to 3 banks and you get $300,000, that's $900,000. So that's the way business lines of credit work. It's called credit stacking. A secured line of credit is, let's say you own your primary residence and you have and it's worth, let's say, $500,000, but you owe $100,000 on it to zero. So then what you could do here is either a cash out refi or a HELOC, depending on this interest rate and the amount of the remaining balance and the term on the remaining balance. Because if you have $100,000 left, you're at 20% LTV or 80% equity. And if you have a 2% interest rate, doing a cash out refi doesn't really make sense, especially if you only have 5 years left on this loan, because this cash out refi is going to be a 30-year loan. But if you can get a HELOC, now you would be left with, let's say, you would get about $300,000, because the max you can do on a HELOC is 80% LTV, meaning max loan amount combined is $400K. You already have $100K on there, so you would be left with $300K. You'd be able to pull out $300K from your existing home and use it as a HELOC at roughly 7 to 8%. Some banks I know will go down to 6.5% because they really want to attract HELOC products from qualified and exceptional borrowers. So what they would do is you would get $300,000 roughly in this example with the $500K house, and you would use that as down payment on the $1 million building. So now you have $300K cash, or 30% down on the $1 million building. But remember what I said at the start. 0% down means using 0% of your existing savings. So this right here is getting that $300,000 from a non-bank account. You're getting it from your house and then putting it down on an investment property. This is totally allowed. With business lines of credit and unsecured credit, this is generally not allowed with agency nor institutional loans. This is, however, allowed with certain private money lenders. So certain private money lenders will allow it, and their interest rates tend to be higher. So the cost savings is that you're not using your existing savings, right? But your cost long term is a higher interest rate, and this is assuming you. Whereas this example assumed, you get 100% or close to 100% of the purchase price. There are ways to do it where, like, let's say you're only able to get, let's say, $300,000 as a line of credit, LOC, business or otherwise, and you want to buy $1 million building. So you would use that $300,000 as 30% down of the purchase price, and then get a loan for 70%. But institutional lenders, this is what I was explaining earlier, perhaps convolutedly, is that institutional lenders will not lend on this, but a private money lender will. A private money lender will absolutely look at this and go, okay, 30,000 is coming from a line of credit, and 70% is coming from me, so I am happy to lend on this, whereas a bank or insurance company may say no. So that's way number 4. Way number 3. Way number 4 is to use a secured line of credit, and then there's way number 5. So let's say you own your home, and that costs $500K, and you have $100,000 remaining on it, right? Balance. So balance value. And you want to buy $1 million building. 1 million purchase price. Okay, so with private money and some institutional lenders, we will do something called cross collateralization. That is basically taking a loan, one loan, but instead of putting a lien just on one property, we will put a lien on both properties. One loan, two properties. Sort of like Two Girls, One Cup, but in reverse. One loan, two properties. So you're using the equity from this to act as the down payment on this. That way you get the full $1 million loan amount. You're getting 100% financing. $1 million loan, and your interest rates will be higher interest rate. But you only pay one origination fee. And one closing cost. One loan's closing cost. And you're collateralizing it. You're using two properties as collateral. And I don't want to say you're limited to 2 properties. You could do 3 properties. You can do 10 properties. You can do 100 properties. It all depends on the amount of equity and the size of the loan. Depends on equity and size of loan, because the loan needs to be secured against something that is guaranteed to recover the lender's original $1 million, because they're giving you $1 million, 100%, no down payment. So they want to make sure that if they sell the building and it does not sell for $1 million, let's say it sells for $950,000. Well, they got to get that remaining $50,000 elsewhere, and then they got to get the cost to recover that $50,000 and the $950,000 from elsewhere. So they need a second property to sell, and then recover the money from that, and then you are going to be left with the proceeds from that sale, but you lose the actual property. That is called cross collateralization. So let's do a quick review. The first way is with an equity partner. You get somebody else to put up the down payment and the loan is in both your names. The other way to do it is seller financing. You get a loan directly from the seller for a part, for either the entire property or just a smaller portion. So they might do, okay, we'll finance the down payment. You go out to a third party like a bank to get the remaining 75%. And that does not generally work because banks will not lend on properties with seller financing. So you normally have to go to a private lender just to do that. But if you do want to go to a bank, there's another way to do it, and it's called a joint venture with the original seller. So what you would do would be you get 75% from the bank, you pay the seller 75% and say, hey, you hang on to that remaining 25%, and the new property, the new title for the same property will be in both our names, and then after a year, I will refinance you out of it, or in a year or 5, I will refinance you out of that remaining 25%, or I will sell the building and give you that 25% that remains. And the reason you may choose to do this is because you want to save your cash to make improvements to the building in order to force appreciation, in order to increase the value of the building, so that when you rent it, you're getting higher rents, and 2, when you sell it, that you are able to get a higher sales price. So those are 2 of the reasons that you would benefit from doing this, and that the seller can think of you as a safe bet. Assuming you have experience backing you up as either a property manager or experienced flipper or experienced multifamily or rental property investor. So that's way number 2.5. Another way to do it is to use unsecured lines of credit to either get 100% of the purchase price or just enough to cover the down payment. And if you're going to get an unsecured line of credit just to cover the down payment, you will likely have to go through a private money lender as opposed through an institutional lender like a bank. Then a business line of credit, same, is a type of secured line of credit. Another type of unsecured line of credit is a personal line of credit, where you're depositing money into a bank, and whatever you deposit into that bank is willing to give you as unsecured lines of credit, as a personal unsecured line of credit. Another way to do it is a secured line of credit. This is way number 4, and that's basically taking equity out of an existing property and using that equity via HELOC or cash out refi to act as a down payment on the purchased property. Way number 5 is cross collateralization. So you're not getting a loan on the property that you currently own. You're just using the equity. You're using it as collateral to get 100% financing on the new building, which just means that you have one loan and you're promising 2 properties instead of just 1 property in case you fail to make payments. And when I say 2 properties, I actually mean multiple properties. You can use as many number of properties as required to get 100% of the purchase price as a loan. And then a bonus 6th way is to get a 1 to 4 unit, well, let's say 2 to 4 unit multifamily building using a USDA or VA loan. And these loans will go, the USDA loan will cover 101% of purchase price. And that means that 1% covers the closing costs. And a VA loan will cover 100% of the purchase price. depending on the disability rating that you have. So USDA loans are limited to rural areas, and you have to meet certain income requirements just to be able to qualify for this. And for a VA loan, this you have to have served in the armed forces, in the U.S. Armed Forces. But the benefit and the other caveat is that you have to live in one of the units for at least 1 year. Units for at least 1 year. So if you are just starting out, if you literally have no money but you have decent income, if you're earning, let's say, $80K to $100K a year in California, there are plenty of opportunities in this space that you can find and that I can help you find, even if you have zero money for the down payment right now. But you get a building for free, you get a benefit from the equity appreciation, or the appreciation of the property as the property price goes up, and your equity increases. You can then sell, use that money to act as a down payment, and purchase another property. We're probably repeating this strategy 2 to 3 times before you have enough to go through with either just using it as a normal down payment or getting the experience points you need to do one of these ways. Because if you're doing it with an equity partner, they're going to want to see some experience, they're going to want to see some skill on your part before they just agree to go into business with you, because they're not just going to go into business with anyone. And this experience will help you be better at identifying good properties to bring equity partners into. Same thing with seller financing, where they're like, okay, great, but why should I do this for you instead of somebody else? How do I know you're not just going to crash and burn this property by poorly managing it? You want to show that you have property management experience. And if you're just starting out, this is the way to go if zero down is your goal. Now, if you do not have if you don't want to buy in a rural area, if you do not want to do, if you're not a member of the armed forces, then the way to go would be FHA or conventional, first time home buyer. And this is for conventional loans. You can do as little as 3% down, and for FHA loans you can do as little as 3.5% down. But the idea is that you choose a 1 to 4 unit building, and then you rent out one of the units, and or rather you live in one of the units and you rent out the rest. And why do I say 1 unit building? Because some single family homes come with an ADU, or an additional dwelling unit in the backyard, or maybe they have a garage conversion that has been turned into an ADU, into a separate living space. So, and then you can rent that out, and that will help you pay part of the rents, but you will still need the income to qualify for the loan, so that your total income, including rents, is equal to 50% or less. Generally speaking, we're looking for well, actually, let me put this another way. Your total debts including mortgage is equal to 46.9% to 50% of your total income, including rents. So those are 6 ways that you can buy a property with zero down. I hope that was helpful. Thank you very much.